Investing isn't typically a get-rich-quick tactic that you can do for a short period of time and expect to make a significant amount of money. It's often a long-term process that requires patience, commitment, and keeping calm when the market fluctuates, as they will. A long-term investment usually offers a higher probability of maximizing your return over a 10-year period rather than bringing you a high return in just a few years. In fact, if you decide to enter the investing world, make sure you are in it for a long term. Sticking with your investments for a number of years comes with so many advantages. So in this video, we are going to discuss the advantages of investing for a long term. Hey guys, it's Youre here with Dividend Investing, and welcome back to another video. You see, when you start investing and you experience your first market drop, it can be quite stressful. Your first instinct may well be to sell your investments. However, by doing so, that's when you're going to make your losses real. Think about it. If you remain invested during difficult times, all you will see is a number go down on your dashboard, and this figure could well go up in the future when the markets bounce back. But if you sell when the markets are down, you're going to make your losses real, right? So an example that has since gone down in stock market history is Black Monday. This is when the Dow Jones lost 22% of its value in October of 1987. Now, the majority of investors left the market, but those who didn't panic and stayed invested in large cap stocks were rewarded with actual returns of 16.6% in 88 and 31.7% in 89. So when it comes to investing, even some of the best investors can react to a market bump, even if it's a small one. However, market bumps won't knock you so much if you are investing for long term. There's a phrase common to investing which goes something along this line. The ball may drop, but you want to make sure you are there for the bounce. Investing for the long term offers a number of advantages that investors who try to time the market or day trade over short term simply can't take advantage of. Here are 7 reasons long-term investing is the best for you. Advantage number 1, it takes emotions out of the equation. One of the great aspects of long-term investing is that it almost entirely removes your emotions out of the equation. A market that jumps 10% in a matter of days isn't going to have you sitting on the edge of your seat to sell. Now, sticking with stocks over a long-term period allows you to instead focus on the meat and potatoes of your investments, which is the long-term growth outlook of a business or the viability of a new business model. Advantage number 2, data always shows you are always right. Historically, if you align your portfolio for the long term, you are more likely to make money. Although stocks do have roughly a 50-50 chance of rising and falling, stocks can only fall to 0, but they can rise infinitely. If you let your winners ride, there's a good chance that over the long run, you are going to see your portfolio grow in value, especially if you focus on a high quality business. Reason number 3, compound works to your advantage. Buying stocks for the long term allows you to take advantage of compounding, or the ability to reinvest your profits over time to generate even a greater profit potential. Time is your greatest friend as an investor, and being able to reinvest a dividend at 3% can make a major difference in your wealth come retirement. As an example, simply pocketing a 3% yield will double your money about every 33 years, assuming no dividend or stock price growth. If reinvested back into more shares of the same stock, your investment will double in almost 10 years. How does compound return work? If you imagine a snowball rolling down a hill, steadily growing in size as it accumulates more snow, then you are close to understanding how compounding return work. Year to year, any return on your investments gets invested again, and just like that, your money grows over time. Here's an example of compound return. Imagine I invest $10,000. And on that $10,000, I earn 5% dividend on this investment. In year 1, I make $500, which is paid back into my fund. In year 2, I make a return of $525 because not only did I make a return on my initial $10,000, but also on the $500 invested dividend I earned in the previous year. Repeated over several years, compound returns could help my investment flourish. Reason number 4, it's really easy for anyone to do. One of the greatest aspects of long-term investing is that anyone can do it. It doesn't take a Warren Buffett to pick out a portfolio of well-run businesses and hang on to them for 10, 20, or 50 years. Sure, you are not always going to be right. Who's always right? Even the greatest investors are never right, right? They are wrong sometimes. But with long-term investing, there are no hassles about learning different trading styles or platforms, since you won't be an active trader. Advantage number 5, you sleep better at night. My personal favorite is that being a long-term investor will always allow you to sleep better at night. You won't have to wake up in the opening bell every day to look at your stocks and see how they're doing, because chances are the business you are looking to invest in are high quality company, and therefore the chances to be volatile will be relatively low. And finding dividend paying stocks that other long-term income investors are seeking out is typically a good way to keep your portfolio volatile low and your stress level at a minimum. Advantage number 6, it's easy to correct your investment mistakes. Remember that point I made? One of the important aspects of long-term investing is that it allows you to correct some of your mistakes. It means you continue to stick with companies that have demonstrated strong growth, and perhaps adding to companies whose businesses models are still intact but have fallen on some temporary hard times. Now, riding your winners over the long run tends to fix a large number of, if not all, investing mistakes. Reason number 7, your investment risk drops. Finally, investing over the long run reduces your investment risk by removing lost opportunities. Now, trying to dive in and out of the market at just the right time could result in you missing the big up days in the market. A study compiled by the JP Morgan Asset Management on the SP 500 between 1993 and December of 2013 showed that staying invested all 20 years would have netted a 483 return for investors of the broad index. Now, missing just the 10 biggest moves up in that time span could have cut your return to just 191%. Miss the 30 best days in the 20-year period and your return was less than 20%. The point I'm trying to make here is that staying invested reduces your risk of missing out on the big gains in the market. Thanks for watching. Don't forget to give this video a thumbs up and consider subscribing to join the journey of dividend investing. See you in my next video.